response from the central banks, from the Federal Reserve and others to the question of inflation. Can the Fed, though, afford to take a gradual approach, given where wages are, given where prices are?
Good morning. Well, when we look at things, I think at this point it's important to take a step back, take a good breath and look at the situation. And what we're seeing for 2022 is really, the pandemic finally ebbing, better operating environment for companies. We're seeing demand destruction, consumer sentiment coming down because of the bout of inflation. We are also going to have base effects that are going to come into play, especially in the second half. And last but not least, we have a vast number of central banks which are hiking interest rates in a more or less aggressive fashion, especially in emerging markets. So putting all this together, we feel that the market is probably underestimating the cumulative weight of all this on the inflation picture as we go through 2022. We know the first quarter is complex. That was in the card already a long time ago. And therefore, it would be ill-advised to go so aggressively.
Geraldine, yesterday, good morning, first of all. We had a good conversation with Philip Hildebrand, and he was saying, look, interest rates are not going to help the kind of inflation we're dealing with because it comes from a supply crunch. Here he is.
Monetary policy is not at all the only game in town here, no longer. And I think that's very important. You can raise rates more aggressively, but that's not going to ease the supply constraints that are the underlying cause of this higher inflation.
Geraldine, do you disagree with that? Or actually, could we see a big policy mistake because of it?
No, I think I completely agree with that. I mean, there's a combination of factors. Of course, central bank got it wrong last year, but who knew there would be a Delta wave and an Omicron wave? This one you would have needed a crystal ball. We definitely see the operating environment getting better into 2022. Shortages have peaked, and therefore the picture, into 2022 is going to ease when it comes to inflation. And as I said, there's also, a massive fiscal withdrawal as well in most countries, in particular the US, 6% of GDP. So to cut a long story short, the pendulum has swung from, no hike as far as the eye can see to the situation now when the market is probably going over its skis when it's come to thinking that it needs so much hiking and the situation is out of control.
OK, so the market's a little over their skis on this. The balance sheet, though, is also a prospect for this year. Does it complement the rate hikes or does it replace them? And what would quantitative tightening mean for the bond markets?
So the view there is that because there's so much excess liquidity in the system, in the beginning it probably doesn't bite that much. Eventually probably has a bit of an impact, especially because it might steepen a little bit the yield curve. So altogether, of course, this would be equivalent to some tightening, but maybe not that dramatic.
What would be, Geraldine, the most dramatic thing that you could be invested in right now? Are you expecting some kind of correction on something quite big that the market's not pricing in yet?
I think the market's gone a long way into pricing things. And now, of course, the thing that is on most people's mind are geopolitical tensions. And in those moments, hard to take a view. These things are always in the balance that could, of course, bring volatility. But in general, we think that the volatility that we are encountering at the moment is not synonymous of risk, but rather opportunities, because the broader picture, the medium-term outlook for the year of 2022 remains unchanged, and it's a pattern of slowing growth, however, a growth that remains above potential.
How are you positioning in the sovereign bond space and the corporate bond space, and where are you trying to find spreads that really return give decent returns and have that risk return level that is going to align with what you're looking for?
So we started from an underweight duration position starting 2022, but of course now with the sell-off that we have seen and all the improvement in the outlook, we are coming closer to a fair area with what the market is pricing in terms of hikes by central bank. So getting closer to fair, it's not like a bang the table right here, right now, but certainly coming into a zone where fixed income is becoming more attractive. When it comes to spread and credit, it's all about selection. We still like securitized, non-agency mortgages, financial spreads, and selective reopening sectors.